Okay, then I suggest we start. It's now 12 o'clock. Welcome everybody to this third policy series of the European Banking Institute. It's also the last event before the end of the year. And I'm very much looking forward to this because we now have quite an established series in this regard. And I will speak a little bit later once we finish the session also about the next events to follow in the next year. Today is about the 2020 Risk Assessment Report and the transparency exercise of the European Banking Authority. And we're very happy that the European Banking Authority is presenting this topic at the European Banking Institute. Yeah, and I'm very happy also to welcome in this part our keynote speaker, who is Andreas Pfeil. He's a senior bank sector analyst at the European Banking Authority in Paris, relocated, I guess, this year from London to Paris. And now, I guess you cannot enjoy Paris, but you're in home office for the last weeks and months. His focus is on ongoing risk analysis in the Euro area banking sector, including risk assessment report, the risk dashboard, the industry working groups, NPLs, and several country-specific stress tests. He has studied at the University of Hohenheim, which is Stuttgart, and before joining the European Banking Authority, Andreas joined PwC in Frankfurt. He worked at IFRS transformation project at the big European banks, and he was also having a 3-year secondment at PwC in the Ukraine. It now works for the European Banking Authority in Paris. So welcome, first of all, Andreas, and thanks so much for taking the time to present the latest EBA risk assessment report. As a co-speaker in this, we have invited Gonzalo Gasós. He's head of Prudential Policy and Supervision at the European Banking Federation, leading a unit in charge of risk management and supervisory practices, crisis management and economic analysis and data research. He's a good friend of the European Banking Institute, if I may say, and I'm very happy that he's also joining this event here today. Gonzalo is working at the EBF since 2009, where he has been managing the Banking Supervision Committee since 2012 and the SSM Strategy Group since 2014. From 1995 to 2009, Gonzalo held several senior positions at Santander Banking Group and began his professional career in the financial services division of Accenture. Gonzalo holds a master's degree of economic science and business administration from Universidad Autónoma in Madrid, which is also an academic member of the EBI. So very much welcome to both of you. And without further ado, just a few words. Obviously, the risk assessment report is a regular exercise of the European Banking Authority. In these times, a very, very important topic, obviously, because the situation, at least to the extent I see it, is not that clear at the moment. So it's very interesting also to get an analysis of the data from the European Banking Authority and have it presented here. The report is absolutely fresh. Andreas, I think you published it on Friday on your website, the EBA website, and you have prepared a presentation which will last around about 25 to 30 minutes. Then I will give Gonzalo the chance to reply to this from a banking federation perspective. But in any case, we will always have the possibility also for the audience to ask questions. We have here a Q&A tool at this WebEx seminar, and you can always ask your questions in this regard in this tool. But I would suggest we start first of all with the presentation from the EBA, then have Gonzalo speaking, and then we can dig into the discussion. Thanks very much for your attention, and then I hand over to you, Andreas.
Thank you, Thomas, and thanks to the EBI, NH, and colleagues for the invitation, and happy to present here and today. Welcome, everybody. And yeah, as Thomas already said, actually from Paris now, yeah, the presentation of the risk assessment report and transparency exercise. So this is also important to stress that we publish these two exercises together actually on our website. So you have, let's say, the PDF, but also all the Excels for those who are interested in. And this is normally mainly used also by analysts. Very important also to say that most of what I say now is rather, let's say, private views. Not that you say in the end the EBA said something like this or that, please. This is also important to stress. So getting into the topic, well, the key point is, of course, the big or huge uncertainty at the very moment. As one can see, for example, on the top left side in the chart, the GDP forecasts for this year, how they will actually emerging over the year. And when you see this huge drop of the forecast for this year in March, this was let's say the start of the whole crisis. And despite dispersion of the forecast, this I think very well reflects all this uncertainty. Even though, well, let's say the corridor is now narrowing, but we are anyhow also, of course, nearing the end of the year quickly. Banks have suffered a lot this year, in particular also European banks and stock prices. They saw, let's say, I would even call it a free fall at the beginning of the year, yeah, when the crisis of pandemic emerged. And recovery has not been so strong so far. So it's still rather weak, and well, it's of course, let's say, also due to all the uncertainty. Well, what another key parameter we normally look at actually has recovered quite well then over the remainder of the year after March, April, May. Is the volatility on the markets. So at least this is a kind of has calmed down a bit. There's still from time to time some spikes in it, but at least let's say there we see some calm. But it can also always be, you're never sure about this. It can always be, of course, also the calm before the next storm. Even though we would not necessarily expect this for the very moment, but of course one has to be cautious. When we look at banks, the starting point for the whole thing is, of course, the capital position. To see and understand how much losses, let's say, banks can bear in the worst case, for example. And what we have seen in this respect is, well, capital positions are, as we would call them, are rather solid at the very moment and across the board. So they've also risen even over this year, and this is due to an increase in retained earnings, other reserves, and this is also partially, at least partially, due to the retention of dividends. Also the risk-weighted assets, also the denominator, actually declined this year. So what should also again be cautious, not saying and getting overexcited. Well, CET1 ratios are rising, are still on the rise despite all the crisis and so on. So this is not least due to a contraction in RWAs. This is, for example, also due to supervisory measures like SME supporting factor or similar. But also due to a certain change in the asset mix. So, for example, there have at least been some replacements of common, let's call it, corporate exposures with guaranteed exposures. And this has contributed to a decline in the risk weights, but also a rising share of cash deposits with the central bank, for example. So all these trends or ideas are also then actually reflected in the leverage ratio, which saw a decline year over year when we look at Q2 figures. So this just confirms, well, we had seen a decline in risk weights. When we look at the buffers, so as a key parameter, as I just said, well, what can banks bear? What losses can they take? Or it comes a kind of critical. So it still looks it looks comfortable for the moment with the management buffer, as we would now define it in this case, above OCR, overall capital requirements, so above all buffers, and P2G around 3.6 of RWAs around 320 billion. A key topic And this was a kind of interesting. Well, we focused a lot on, of course, on asset quality when we published the report, also in the analyst and press call afterwards, or before publication, and in the press release. So it's of course a key risk. So where is asset quality going at the moment, and what are the expectations? But when we read the coverage. And there was quite a lot. The collection was 30 pages then on Monday of the press coverage that we have from our press team. So it was a lot on profitability. And of course, this is a key issue. When you see it dropping, well, it has slightly recovered in recent years, very slightly. There's still a structural issue. But of course, now it significantly contracted. We look at Q2 figures in the report. RE profitability has a bit recovered in Q3, but it's still, let's say, subdued, and it's mainly driven still by increased impairments, of course, but also a contraction. And this is, let's say, the impairments. This is clear and obvious, and nothing else to be expected. But also, I'm worrying that the revenue side is again or still under pressure. In particular, for example, net interest income. This is also what you see on the top left chart. What was a kind of surprising in a very first step when you just saw it? Well, the operating expenses, they actually reduced and well, they at least buffered a bit the negative effects from impairments and revenue side. So this is maybe, well, hopefully at least a bit of this, let's say, reductions might be of permanent, might be more permanent, but this is still, of course, the big question. How many of these cost savings, let's say, can be taken also into the future? As we understand, of course, well, this was due to office closures. You also understand that, for example, some banks put some IT projects on hold simply because the consultants could not come in-house. It was also closures of branches, temporary, and similar, let's say, effects. So it's never clear, and also to whomever you speak, well, will it be of permanent nature or just temporary? Well, this is one of the big questions. Well, Q3 at least confirmed the declining trend. So, well, indications might be there that banks really successfully work on their cost side, but you, of course, also understand, well, this is not so easy. We can always put pressure and pressure. Well, cannot really put pressure, but say, well, this is an issue. So we also understand that this is, of course, a kind of challenging. And then we go into the key topic of asset quality. So where it's also not necessarily surprising, but of course, let's say not supporting the message that we have an issue here. For the moment, NPLs are not really on the rise. Q2 data saw a small rise in NPLs. In Q3, it looks a bit like they declined even a bit again. The NPL ratio was still on a decline. Well, but this was mainly driven by a denominator effect. So also in Q2, despite a rise in NPLs, the NPL ratio declined, but this was simply due to the huge rise in loan volumes in Q1 and Q2, which also actually reflected, let's say, very, very well that banks this time really, let's say, tried to help during the crisis and not stopped lending, for instance. Yeah. And what is also important, well, when we say we saw this decline or decrease in NPLs in recent years, this is not, let's say, this is broad average looking at the EU banking sector, but it's always important to stress there's still a significant number of banks that have not yet really managed to improve their asset quality or repair their balance sheets, actually. So also this is something we show, for example, in the report. Well, there are also still banks which have, for example, still old vintages of NPLs on board, and this is always this big risk when you go into a new crisis now. Yeah, in which NPLs might presumably be on the rise, and you still have a lot of old stock of NPLs on your balance sheet, it will be increasingly difficult to manage those. And what we normally also say, and supervisors and other regulators then say, of course, well, the problem is also when you're stuck with dealing with NPLs, yeah, and trying to offload them, restructure the borrowers, similar, yeah, then how to do new business when you're stuck with your old, let's say, with your old stock of NPLs, for example. Looking further on data, another key aspect we also cover in the report is actually that the impairments, provisions for performing loans actually increased. So they saw these accumulated impairments for performing exposures. They saw a significant rise, whereas for the non-performing exposures, actually this was still, let's say, on kind of low increase or no increase for the very moment, which is of course also linked to the idea that for the moment we do not yet see a rise in NPLs, and similar in stage 3 loans. Yeah? NPLs are a bit broader, but of course it's roughly comparable with NPLs. And here, as I said, well, we hardly see an increase. But however, there are indications for deterioration in asset quality. One would be, for example, the significant increase in forborne loans. This is on the one hand, of course, a sign, well, that there are issues in the balance sheet. There are issues in asset quality. Banks start dealing with potentially struggling borrowers. This is, let's say, a key indication. And what would also be important to stress here that in general, with we had these guidelines on moratoria. So the general, let's say, approach would be that all these moratoria, they're compliant with the EBA guidelines, which is we will see it on another slide. For many of those, actually the case. So they're not part of these forbearance measures. These are rather, let's say, measures. Also, when you look at the data, which are a kind of first trials attempts to restructure similar things, loans, which of course is welcome. So banks do not shy away. They do not close their eyes. This is also a clear indication banks are dealing, let's say, with the borrowers. They take care of this topic, and so this might also be, let's say, a good indication. Still, of course, it's also clearly showing there's a potential issue on the rise with asset quality. The same we see with stage 2 loans. They were, let's say, on the rise too in Q2. Indications for Q3 are that they decline actually a bit, but really only a bit. And also what we saw on the slide before, but which we also see now in Q3 data indicatively, is that actually the coverage for stage 2 loans is further increasing. Then the chart on the bottom left shows, we think, quite well these moves of stages year over year as of Q2 this year. We see a lot of moves from the blue part in the left, which is stage 2, out of stage 2, let's say, and then mainly into out of stage 1. So the blue part is out of stage 1 into stage 2. Which is the orange part on the left side. So there are also some moves out of stage 1 from the blue to the red, which is stage 3. So there were also some institutions actually, let's say, moving out directly out of stage 1 into stage 3, which cannot be, of course, be the case. Which was kind of funny. We were dealing, for example, when we deal with the data for the RAR, and this just on the sidelines. And then we look on trends for asset quality for different sectors, and then all of a sudden, let's say, there was a strange move with financials. Financials, one of those financial sector, one of those sectors with the biggest increase in, let's say, biggest deterioration in asset quality indicators, and we just thought, well, what is this? What's going on there? Well, this doesn't make sense. Well, banks are not there. There's no intervention or resolution of a bank or so far, at least, yeah, nothing we are aware of. And then we actually recognized, okay, well, this is of course Wirecard, yeah. For instance, so this is always funny when you look on the data. So, for example, when you see some of these red things there on the left, there's an exception for some banks, but there are always also then some stories behind it. But for example, also because this is year over year, this Singapore exposures with commodity traders and so on, this is also affecting this. On the right side, then we also had some questions, of course. Why do we see a reduction in red on the right side of the chart? Yeah, in the stage 3 allocation. These were several, let's say, NPL transactions, which still went through even beginning of this year. And for example, today, well, and we also understand, well, they're still ongoing. We know that Unicredit, for example, announced today another transaction of a billion, and so this is at least something. This is a very nice chart. We like actually very, very much, because there are also so many stories behind it, but also a general trend. Yeah. So the chart on the bottom left. As I already mentioned, and maybe on this where we also cover it well in the RAR in boxes, but we had a separate publication on this in November. We have the use of moratoria and public guarantee schemes, well, the PGS, public guarantee schemes, where we have roughly about nearly 1 trillion, I would always say, 900 billion of moratoria reported by banks. And as I mentioned before, well, this 900 billion of, if you want to call it like a forbearance measure, we should not, we don't do this, yeah, but this would add to the forbearance measures we saw some charts before, yeah. So and well, it's 7.5% of total outstanding loans, but better to look only on the NFC, exposures. And household exposure, there's 9% for NFC, 6% for households. And just checking the distribution of the moratoria is, let's say, a little bit skewed towards NFC. 60% of the loans on the moratoria are towards NFCs, 40% are towards households. Which is also interesting to look at, because, well, this is this big black box. How are the loans under moratoria actually moving? Where are they going? Also, when they get out of the moratoria, then well, indications when you look at bank statements or then bank discussions with banks, discussions with analysts. Well, a lot of statements they actually say, okay, well, but I would also. Personally, I would have been shocked. Well, if a loan is under moratoria and doesn't have to pay for 3 or 4 months, and then it gets out of moratoria and client is not able to pay, then it's really a bad situation. Well, I know many people are really suffering now, and I can understand it. They lose their jobs. It's a horrible and terrible situation, honestly. But of course, well, then saying, well, they're now all paying and they're just 0.5 or 1% of those loans under formerly or previously under moratoria are now back to payments. I would be very cautious with such statements. Not sure if this is really of a long-term trend. Then, for example, if you look at the stage 2 share of loans under moratoria, we see this is double the share of average loans. Around 70% of the loans on the moratoria are in stage 2. It is even increased. So the indications are in Q3, let's say in the latest data. So it's not like we can, let's say, sit down and say, okay, it's all going well and everything is going fine with loans on the moratoria. We hope the best. We also hope the best for the borrowers and the overall economic situation. But well, there are certain indications that are a bit of worrying. So on the PGS, well, we have around 200 billion of loans under guarantees. This is mainly the big degree or biggest chunk is nearly 100 is of course NFC exposures. There's not much to retail. Well, the exemptions are, for example, well, if there's a self-employed, so then it might be retail exposures. So, but normally this is really to towards NFCs. And then also what we see in moratoria as well as PGS data is that the sectors actually most affected by the crisis, they're also the biggest users of these measures, which is of course fine. This is good, so it hopefully helps. It hopefully helps survive the worst times. Still to be seen what will happen when we get out of it, of all these schemes. Hoping for the best, but still, well, of course, there are also worrying signs, and it's not like we are, let's say, completely happy and all is going well. We will have to see. We also covered, and this is, I think, the first time something like this has been ever published from in this area of the world. So we have quite detailed information actually on climate risk, focusing on transition risk actually in the analysis. This is an exercise. This was an exercise still going on among with 30 participating banks across different size classes. Biggest ones, most of the biggest ones are actually in Europe, and well, they are also actually, well, there's broad willingness to participate. So there's also cooperation. So this is going very well with let's say with CAs, with other regulators, with supervisors, but also with the banks. So this is a really cool project. I'm not directly involved in it, but as I see it, and let's say one of the key messages here would be that around 50%, it's 55%, however you approach it, yeah, of large corporate exposures are actually towards, let's say, climate policy relevant sectors. So which are, let's say, which have increased vulnerability towards climate change, transition risks. We did, let's say, do two analyses there, looking at exposures NACE code. I think it was the 4th level NACE code or so, yeah. But also looking at greenhouse gas emission data from actually the borrower, and there 34% of the borrowers are, let's say, on the bottom left chart, towards the right side with the emission and intensity of medium or higher. Yeah, so this is also quite a huge chunk of exposures. So let's say, but it's always difficult then to say, okay, is it a 34%, is it a 50% or so? But the key message is around 50%, half of the exposures, which might actually be particularly vulnerable to climate risk. So then coming to an end, having the time in mind, and what we also cover, of course, is funding liquidity. It's a kind of a less of an issue at the very moment, thanks to central bank measures. But we also saw, let's say, of course, in starting, I think it was already in April and at least May, banks also came to the market. Market-based funding was really going very, very well. There were not so many covered bonds. It was more focused on senior unsecured, a lot subordinated and non-preferred, so MREL eligible world, because what we also saw a contraction in spreads, and which was reflected in IDREX, for example. So banks used the chance to issue. They even pre-funded 21 volumes already in the end of 2020. So this was something going well. So then, of course, not too much excitement about the spread contraction, because, well, we also know this is not least due to central bank measures, of course. Yeah. But at least banks use these opportunities to issue, to place that. Also important to say, of course, well, biggest increase on the funding side. So of course, the central bank was the central bank funding. Of course, like TLTRO, for example, in the euro area, but also in other jurisdictions of the EU, where similar measures were exercised or provided by central banks. We also have a liquidity sensitivity analysis. We should not call it liquidity stress test, but it's a bit like this, yeah. In the risk assessment report, where we actually see that, let's say, the liquidity buffers looking at a 3, 6, and 12-month horizon, for example, they suffered a lot in March, April, in February, March, but then strongly recovered, not least following the central bank measures. Conclusions and policy recommendations. The big thing in the end, and of course, we also say, for example, prudent capital distributions policies are still required in the report. This does not mean anything for any potential dividend and payment statement coming out later today, presumably, or latest some days later this week, depending on how our decisions are going today. But other points are, of course, as we said, is the uncertainty. No one knows where it's going. One has to be prudent, cautious. It's important that banks keep on supporting the real economy, but also being prepared for deterioration, as we said before, or as I said before, well, forbearance, for example, really being proactive on forbearance if needed. Further using, of course, windows of opportunity to build up MREL stock, for example, and cost reduction measures are presumably a key topic also going forward, including M&A. We see national ones. Let's see how it's going on the cross-border. Maybe not yet there, but at least a topic being discussed and not covered in the slide so far. But of course, well, there are all these op-risk aspects like technology increased in relevance or AML issues. They're not off the desk for the moment. So that's it from my side. I would now stop sharing and back. Thank you.
Thank you very much, Andreas, for this interesting presentation. I would hand over then now right away to Gonzalo, who can reply basically on this presentation. And I don't know, Gonzalo, whether you would like to refer to one or the other slide, but then please let know, and then maybe Andreas can share it again. Thanks very much, and then over to you, Gonzalo.
Thank you, Thomas. Thank you, Andreas, for your presentation. You have selected, I think, the most important topics out of a very comprehensive report that I always say when I look at this report of the European Banking Authority, this is already a European achievement, because I have memories more than 10 years ago when there was no such information about the European banking system. So congratulations for that. It is very granular, comprehensive. However, we might have slightly different interpretations on some of the issues, and that is why we have this discussion. I think it is necessary to refer first to what has happened this year and how does it compare to the previous crisis. That is inevitable. And I think the great financial crisis was completely different. Firstly, because the banking sector was very weak, and it was the cause of the crisis. Now we have a banking sector that is much stronger and is part of the solution. So that changes the picture absolutely. But there are also other differences. The great financial crisis in the European Union had a very shy response. It was too little and too late, as we have assessed with hindsight. However, this time the policy response has been strong and quick, and more importantly, it has been the combination of all responses on the side of the European Central Bank with the liquidity support, at the same time with the regulatory quick fix by the Commission, also with the supervisory flexibility, and of course the bank's commitment to keep up the level of lending. That was the ultimate objective, at least for this year. So this year, I think we have accomplished the main objective, and we should also include the temporary state aid program of the Commission that has been part of the equation. And it's important to know that many new loans have been extended with the state guarantees. The state guarantees cover 98% of the new loans. Because I've mentioned a raise of NPLs, but at the same time, we need to keep some space in the balance sheet of the banks to keep on granting new loans to other corporates, other households that must sustain the generation of resources for the bank. and at the same time keep the economy going. State and the first the next year. Andreas, with data we are living now, the NPLs are going down in a time when everyone is expecting they will go up. Let me make here two reflections about this. On the one hand, the NPLs are going down because of the very ambitious risk reduction programs that have been deployed bank by bank, as you know, with a follow-up of the SSM in the case of the Eurozone and the SSM supervised banks. And this is a trend that is coming. It's a slow trend coming from 2000. Now, I think to the previous peak of NPLs. But when we talk about the future, I would be a little bit careful about talking about the term NPLs. We have is a presumption that obviously the economy will struggle and there could be some delays in paying back their loans. And we have uncertainty because we have never extended a moratoria program like the one we are currently experiencing now. Of course, that brings up as our uncertainty, but I wouldn't jump to say this will translate automatically into NPLs, because fortunately this time around, banks have more space in the balance sheet, thanks also to those capital buffers that in the report you illustrate. They have also grown from 3% to 3.6%, interestingly. And that gives you capacity as a bank manager to manage your portfolio. And I think this is the key of what needs to happen in the next year. Every risk committee of every bank needs to assess which portfolios and which loans in those portfolios deserve some time, some forbearance, and which others will need to go through a path of guaranteeing or finally entering into non-performing situation. But I'm hopeful that a big part of that portfolio, if we do things right, doesn't need to enter the NPL status. We have a very good example this year. Thanks to policy response, we have avoided a crash. Imagine no response. By June this year, the whole banking system, or a very important part of it, would have probably to a systemic crisis, and therefore so we have put in place a serious policy response, and we need to, I think we need how to phase out in the months, perhaps years. If we cut the moratoria all of a sudden, and there is no other flexibility in the regulatory framework, we might face a cliff effect. But if we think carefully on how to phase it out, we might avoid a crash. So I think we need to build, instead of having a cliff effect, we need to build a ramp. Let me use that expression very graphically. We need to ensure that there is a soft landing, and that will avoid the wave of NPLs. But we need numbers, and I understand analysts have come up with magic numbers of more than 1 trillion NPLs that could eventually come up. But that is if we remain passive. Of course, if we remain passive, we will face 1.4 trillion NPLs, so we will be back to square one with a peak of NPLs in 2015. But I'm hopeful if we do things right, many of those don't have necessarily to become NPLs, and we can take early action. You mentioned a stage 2. That is, I mean, we don't have now information because that's happening bank by bank, but interestingly, in your report, you already point out that there is about 10% of stage 2, and we need to work them out. But within those stages, some of them will become NPL, some others might. We need to go through that granular assessment, bank by bank, to better understand what's going on and give an opportunity to many borrowers to come back to normal payments at the time they can. That brings me also to a comment on forbearance. We know that in the great financial crisis, there was an abuse of forbearance, but at the same time, we understand that a little bit of forbearance is not bad. On the contrary, might do good to the economy and to many borrowers, but it has to be done under much control. Perhaps our regulatory framework that has to be successful. Obviously, time it is very robust, at the same time is a little too rigid. We need to play with that. The EBA did a very good work, in my opinion, together with banks, as we proposed in the European Banking Federation, as soon as the 11th of March, a private moratoria that could resemble the terms envisaged for moratoria by law, and I think that has been a success. At the end, it has had to be extended. Let me say that when we had those conversations at the European Banking Federation, not everyone was in agreement that the moratoria was needed, because moratoria is indirectly can affect the bank, but it's a direct help to the borrowers, not to the bank. For the bank, it also implies certain sacrifices, because you stop paying, you reduce your income, and that also hits profitability, obviously. So it's not all about advantages for the bank when we talk about moratoria. However, we're very open to discuss about which is the right balance between softening certain measures temporarily in the regulatory framework and letting the economy come back and have full recovery. I think I have given just a broad assessment of certain topics, but I'm happy to take any more specific question. Over to you, Thomas.
So thanks so much, Gonzalo. And the line was sometimes a bit interrupted, unfortunately. But let me now kickstart the Q&A session. I have 3 questions from the audience, but I would like to ask, first of all, just as an introduction, one question in relation to, let's say, this report and the different assessments. I mean, you have seen, I guess, Gonzalo, you see this a little bit more positive from your conversations with the banks. Andreas, you may have a bit more cautious view, but I guess it's also in the nature of somebody working in the sector. I know what I'm speaking about. So when I look at this whole situation right now, I mean, there has been a lot of public support, let's say, from the central banks, from the supervisory authorities, from the public sector in the form of moratoria or capital injections for particular sectors. Isn't it fair to say that the view that you may have, Gonzalo, or the view that the EBAs have, is a little bit also digging into the dark? We don't really have a clear picture of what's going to happen in the next weeks and months. And I mean, if I say this now, with all respect, I mean, it is probably fair to assume that the banking sector will come out of this crisis not in a better shape, but more likely in a worse shape, even though they have, as Gonzalo rightly said, entered the crisis in a far better shape than 10 years ago when the global financial crisis started. Yeah, but when would you expect that these whole, let's say, hits are going to materialize? In particular, if I speak now or look into the most vulnerable sectors, and I don't know whether the EBA has also made some particular research in this area. I would be interested in your views in this regard, and then I would also read some questions from the audience. But maybe, Andreas, you want to start in this regard?
Well, yes. Well, indeed. Well, this is a kind of a black box. Well, it was in comparison much more darker at the beginning of the year. It's getting a little bit brighter now. At the beginning of the year, of course, no one could know where is this all going with the moratorium PGS. We now at least have some indications, where asset quality is moving. We have these first indications on deterioration of asset quality, and I'm now focusing on this part actually. We also know about capitalization. We have done, for example, also our sensitivity analysis in spring this year already, where we try to understand where this all might move when asset quality deteriorates to a similar degree like in the last stress test. We have now the new reporting and disclosures on moratorium and guarantee schemes in place. We even have, and this was quite lucky, we have also more detailed reporting on NPLs actually in place starting in Q2 this year, because all this implementation takes a long time. This came in place now this year. So we would say we have now a kind of a feeling where this might all go. But of course, the big question is, will this really, this deterioration in asset quality, the indications we see now, will this materialize in NPLs or not? And I agree to a certain degree with Gonzalo. Well, if banks manage this well, and let's say with a lot of collaboration of the whole sector, let's say, yeah, then we might avoid the big crunch if we are lucky, yeah. But still, when you look, for example, at yesterday, Group of 30, they published a statement with this people like Draghi, Yellen, and so on, and they said, well, we are heading for a strong rise in insolvencies, and also having in mind that, for example, let's say in Germany, other countries, also here in France, and so on, insolvency frameworks are put on hold, are paused, or at least relaxed. Then we also know, well, for the moment, we don't see insolvencies of corporates, which we would actually see in normal times if the legislation was not paused or suspended or relaxed. So we would expect a significant deterioration in asset quality next year. We hope banks will manage this well. We are also confident, but still we expect a lot to come than actually next year. This would be our, let's say, key assumption and conclusion for the very moment. Also seeing what we are seeing now, and then also, let's say, well, we have now the second reporting submission with the moratorium PGS data. It helps us to understand where asset quality is moving, and I think much more clarity than with Q4 data. So that we can all better judge about it, but it's already improving a lot, actually.
Thanks so much. And Gonzalo?
Yeah, I would highlight the question of the graduality of the comeback to normal as the objective we should have in the next, say, 2 years. According to the news we have, there could be a full population immunity at the end of 2021 or beginning of 2022. If that is true and there is no other complication, that should be our target. How can we get there without creating a major disruption in servicing the economy for the banks? And that comes back again to my point about avoiding cliff effects is the art of regulation and banking all together. Now we need to strike the balance, because if you wait too long, maybe you can incur again in an episode of forbearance that wouldn't be interesting either. But let me be more concrete on this. The main instruments that have been put in place by authorities now in direct support to the borrowers are, on the one hand, the moratoria, payment holidays, on the other hand, the state guarantees. But they are fundamentally different in two ways. Firstly, with the moratoria, the help is directly for the borrower. So at the end, the bank, once the moratoria comes to an end, what happens sooner than later, the bank is left with a portfolio of unknown borrowers. The only thing you know about them is that they haven't been paying for the last 9 months. Right, so you need also to understand how they will come back to the payment culture. That's also have some psychological effects, and you need to cut, and then the bank needs to claim the money back again, and that could be hard for certain sectors that have not been able yet to generate the resources to keep up their business afloat. So that's something we need to have a lot of discussion to see how this process can go smoothly without letting that, let me say, zombie companies that have no future can still linger there, being an unproductive asset. However, others that are viable businesses can find a way to come back to business. There are many examples of many sectors that have been badly hit in the crisis, but they could have a future, of course. So that's on the one hand the moratoria, but the state guarantees are also quite important because they attach a guarantee to the loan that has been granted by the bank, and they can multiply a lot the capacity and the leverage of the banks. In the EBA report, interestingly, you portray a scenario whereby the use of moratoria and state guarantees has been quite divergent across member states, and that gives you clues as to what will happen and when and where it will happen when these programs come to an end. The moratoria will be in March 21 if there is no other extension, but the state guarantees, many of them extend over 2 years or even up to 5 years. So you really have a phase-out period that is more comfortable for the borrowers and the banks as intermediaries.
Thank you very much. Maybe if I may add to this question or this statement of yours, more generally or more specifically actually on the topic of IFRS 9 and the application of IFRS 9 now in this particular crisis. What is your view and your experience now in this regard? Because you could also may say, well, we have this expected credit loss right now, but some of the criteria to determine an expected credit loss don't really work in this crisis properly anymore. I mean, if you say you're switching off the insolvency notification in a particular country or countries, then you're just not obliged to move to a stage 3 anymore. Or if you have a moratorium, which is usually indicating if a client is not paying anymore that he's moving to a stage 2. Yeah, this doesn't apply at the moment. So the picture obviously is skewed to the positive. My question would be, first of all, maybe to the EBA, do you have any kind of indications about the development of loans once these moratoria are actually switched off? Did they start paying again these clients, or did the number of defaults increase with regards to these clients? And then more generally or wider on the area of IFRS 9, do you think it actually worked in this crisis, or is it something which actually results because of these measures in a very skewed picture, and banks are actually inclined to move and delay a proper recognition of a client's default? And then, because otherwise I forget it, Alistair Ryan also asked one question specifically to the EBA. Were you surprised that the CET1 stayed that strong? The other one, Alistair, is more related to stress test. I will try to address it later.
Well, maybe the last question first, indeed. Well, maybe indeed a bit surprised, yeah, but it can be easily explained that CET1 stayed strong, yeah. So we had the rise in capital, we had a decline in RWAs, and all of this are kind of explainable. So in the end, somehow one would not have expected it. But what is important, of course, to stress, and maybe this is also something I actually forgot to mention, and I must admit, of course, well, we have all these effects or impacts from let's call it credit losses or impairments, provisioning. Of course, we will also probably see an increase of RWA sooner or later. So there are already first indications in a rise of PDs, of course, that we see, and this is also maybe leading over to the other question, the starting point of this set of questions now, well, banks, of course, as we understand it, at the very beginning, like we did, and probably all the others, the whole world did, struggled a lot. Oh, mamma mia, what's going on now? What's happening? Where's this all moving? Where shall we actually start now with dealing with this? At least after having settled in the home office, but then what are now the key issues to look at? And as we understand banks, I would say, they to a certain degree, if they want, they know where to look at when it's about asset quality, to look at the borrowers. So they had a lot of, in a very first step, as we understand, and I kind of learned, portfolio view. So they looked at the most vulnerable sectors, for example, by nature also, yeah. So they know where to look at which borrowers, which sectors, or also when it's about the household exposures, they know to look at which borrowers, also depending then on which sectors, for example, they are employed, or what the employment status in general is. So of course they have to start from a rather, let's say, high level, from looking at the whole portfolio, loan portfolio, and then trying to dig deeper. And this is a kind of what we also understand what they are doing and what they have done when estimating, for example, or when judging about stages, when it's about the IFRS world, or judging about a default or non-default, or unlikely to pay, which is probably the key assessment needed at the very moment. And well, yes, well, then a bit also reflecting what Gonzalo said, of course, the moratoria, they mainly help for the moment the borrowers, yeah? Not necessarily the bank, yeah? But banks would and should still be able to look, let's say, for example, in the company behind it, to understand what their cash flows are, if they need it. And of course, well, they have to approach this with a reasonable assessment and trying to look at the first borrowers, the big borrowers first, then digging further into the SME exposures, and then digging into the household exposures, for instance. So it's always a leveled approach. So going into, let's say, from the big picture, going into more individual assessments, and this is of course a lot of work to do, which is also what I mentioned a bit, a kind of worrying, because well, a lot of people might be dealing with this, and people who might actually be better dealing with other topics, but of course this is at the very moment needed. I don't know if this answers another question. There was the very first part, I think I forgot about this, but hopefully this is at least addressing it roughly, yeah.
Thanks so much. And Gonzalo?
Yes, you rightly mentioned the question of stage 2 classification as the key determinant on what will happen when the moratoria switch off. And that brings me to the concept of unlikely to pay, which is the characteristic of the crisis that we are facing. Unlike the previous peak of NPLs that we've been dealing with during the last 5 years, well, if we remember at the beginning, the critical mass of NPLs was made of legacy loans that had been there for a long time, and the strategy of the bank was clearly to get rid of them at a decent price in the market, or to liquidate or execute the collateral. That was all. But the nature of the potential NPLs or impaired loans we have in front of us is much more subjective. It's made of borrowers who have never had an arrears in long years. So this is not the classic NPL that's been always struggling there on your balance sheet. And it is made of, is your neighbor, the shop across the road, that has been facing some problems to continue their business. So this needs a lot of sensitivity at the same time, not only just a very strict interpretation of, okay, stage 2 or unlikely to pay. You need to assess that degree of unlikeliness to pay for every borrower and set a path and a program for different buckets of borrowers in the same portfolio in agreement with the supervisor and with the authorities. I think that is the way forward to deal with this, within, of course, the confines of the regulation that we need to comply with.
Thanks very much. We have only 2 minutes left, maybe overdraw a few minutes. But let me then round up with the last questions, which are jumping a little bit the topics. But I would like to make sure that basically questions asked are going to be addressed, because it wasn't always possible in the past sessions. So one of the questions, and I try to bring this across, Alastair, from Alastair Ryan, is in relation to stress tests. And now we're not speaking about the stress test here, but one of the points about this assessment was, and the presentation you showed, Andreas, is it shows data on an aggregate basis in all of Europe. Yeah, would you expect this data to look very different if you now would drill down into the individual countries? In other words, is there going to be expected again some kind of divide between several countries in the euro area or in the European Union once this crisis is over. And the question from Alastair was that the EBA stress test was having, let's say, a high variability of macro assumptions. I don't know how you can fit maybe also this answer into your, or this question into your answer. Is this somehow going to be reflected maybe going forward in a stress test scenario? And the second question was now on a completely different topic, sustainability. You mentioned also the area of climate change, and this is becoming more and more important also, let's say, for public authorities when they are analyzing banks, but also for the banks themselves when they are setting up their risk management. So do you have any overview about, let's say, the regulatory developments in the area of sustainability and how it has to be integrated in the area of risk management? Maybe also, Gonzalo, you have some experience how your member banks are doing this right now. If you could share this, it would be quite interesting as well. But then I would, first of all, again, start with Andreas and then hand over to you, Gonzalo.
Yes, well, let's say dispersion across Europe. Well, this is of course this is broad, and there's let's say nothing to be discussed away. There are unfortunately then countries which have a bigger impact from the whole pandemic, but also, let's say, because of the rise of the virus, but also because of let's say their specifics of their exposures, or the specifics of the economy, focused, for example, on with a lot of exposures or in tourism. And so the impact will of course be different across Europe for the different kinds of banks, but also still on broad average. Also, when looking on countries or so, we're quite confident that banks will be able to address this. We would rather speak about individual banks which might struggle. So we would not point to a particular country or member state. This is also, let's say, we would probably never do it as EBA, yeah. But still, I also believe in it when I say it now, yeah. It's rather about individual banks which might suffer less, let's say, than countries, and this is also what I strongly hope. And of course, well, the different impact, let's say, well, the stress test scenarios, they consider developments on country level too, and are broken down accordingly. And this will be the same this year. I also know and are partially involved, and there are heavy discussions about the scenarios also at the very moment. And I think quite a reasonable approach will be followed. All the countries are around the table when these discussions take place, and I think and I hope they are fair. And again, I believe it. I don't say this because I'm an EBA employer or whatever. Yeah, I hope they will be fair climate risk. This is a key topic also in our regulatory work. For example, we will further work on the analysis, as I said. But there are also more working areas related to climate risk. This is a key topic for us, but we also understand this is a key topic for banks. I would say very short. Well, there's a lot of work going on, and more work will go on in this area. Yes.
Question, Gonzalo. Yes, on this question of climate risk, I would say, in connection with the crisis. Climate risk and the shift of bank exposures towards greener exposures is a long-term trend, and it is a medium-term objective. So that is ongoing, but I think there could be an acceleration due to the crisis. We were talking with DG Comp in the last weeks about the extension of the temporary state aid framework. And as you know, some of those programs are focusing in particular in greening the economy as a major objective of the European Union. So that can give a little bit of a push, and banks are, in general, they have embedded this question to varying degrees and in different forms, but altogether as a system, we are progressing in that direction, shifting towards greener exposures. And this is very much in line with the objectives of the European Union. As a matter of curiosity, we were reviewing the state aid framework of 2008, and it also included a chapter of greening the economy. So this is a very old issue, but now it comes with bigger emphasis, and it's at the top of the agenda of the European Union, and banks are very much in line with that. Let's take the opportunity.
Thanks very much. Now we have 5 minutes past 1 o'clock, so we have overdrawn a little bit, but thanks very much, Andreas from the EBA and Gonzalo from the EBF for participating in discussion, for giving us an update about this latest report. Also, thanks to the audience. I would like to especially also thank Major Smole, who is helping to prepare this event. All of you, a very nice Christmas and then a Happy New Year. I hope we see you soon again. I couldn't say on this channel, but with the EBI. And we will have the next policy conference 14th of January, which is also the first event of this year. So again, thanks very much and all the best. Bye-bye.
Thank you. Bye-bye.
Bye-bye.
Thank you. Bye.